Right here is a perfect trade setup that showed great accuracy in identifying the exact support level. While other traders were guessing where smart money was positioned, this volume indicator revealed 4 different POC confluence zones that predicted the bounce with mathematical precision. What's even more impressive is how this indicator doesn't just show current volume, but also stacks multiple timeframes to reveal where institutional money is really flowing across different time horizons. And in this video, I'm going to reveal this game-changing tool to you, show you exactly how the multi-layer analysis works, and give you 3 powerful techniques to read institutional order flow like a professional volume trader. Let's get into it. First, head over to TradingView and pull up any chart you want. I'm using the 1-hour time frame on GBPJPY, but this works on any market, any time frame. Click on Indicators and type in Multi-Layer Volume Profile. Make sure you select the one by Big Beluga. Now, this isn't your standard volume indicator. This is institutional grade analysis that Wall Street firms pay thousands for. Most volume tools only show you one perspective, but this powerful system stacks up to 4 separate volume profiles simultaneously. Profile 1, Full Period Analysis. Profile 2, Half-Length Perspective. Profile 3, Quarter-Length View. Profile 4, 1/8 Length Focus. Each layer reveals different institutional behavior patterns, from long-term accumulation zones to short-term distribution levels. After loading it on your chart, you'll see horizontal volume bars extending from key price levels, with the thickest bars showing where the most institutional activity occurred. The bright blue POC, point of control, lines mark the exact price levels with maximum traded volume, your institutional anchor points. But the delta volume labels is what make it supercharged. It shows you the net difference between bullish and bearish volume at each layer. Positive delta means institutional buyers dominated, and negative delta shows institutional selling pressure. Most traders struggle because they rely on random signals without a clear system. That's why we focus on structured strategies and automation, so you can study how these tools work step by step, without guesswork or emotions. If you want to learn more and see exactly how these strategies are applied in real market conditions, click the first link in the description. Now let's get your settings right for maximum accuracy. Double-click on the indicator to access the settings panel. Set the length parameter, which controls how many bars each profile analyzes, to 100 for most timeframes. Next, set the number of bins to 50, as this controls the granularity of your volume analysis. More bins give you finer detail. Fewer bins provide smoother, broader volume perspectives. Then, enable all 4 profile layers to see the exact anchor points. I recommend using the default blue for POC lines and keeping the volume bars with gradient transparency. This makes it easier to spot confluence zones where multiple layers align. Once you're done, click OK. Now let me show you 3-layer analysis techniques that give you great accurate insights. Layer 1 is the single profile institutional zones. Start with the full period profile, Profile 1, to identify major institutional accumulation and distribution zones. Look for the thickest volume bars, as these represent price levels where institutions spent the most time building or offloading positions. The POC line from Profile 1 shows you the most accepted price for the entire period, which now becomes a magnetic level for future price action. Here's a pro tip. When price approaches a high volume zone from Profile 1, check the delta volume label. Strong positive delta indicates institutional buying accumulation, perfect for bounce plays, but a strong negative delta reveals institutional distribution, ideal for rejection trades. Enter long positions when price tests positive delta zones with bullish candle patterns, and enter short positions when price reaches negative delta zones with bearish rejection signals. Layer 2, the multi-profile confluence detection, is where it gets interesting. This is where the great accuracy comes from, when multiple profile layers align at the same price level. First, you want to watch for POC lines from different profiles converging at or near the same price zone. Now, when Profile 1, Profile 2, and Profile 3 all show POC lines within 10 to 15 pips of each other, you've found an institutional confluence zone. These confluence areas represent price levels where institutional activity was significant across multiple timeframes, from short-term positioning to long-term accumulation, and price almost never breaks through true confluence zones on the first test. Enter when price tests these confluence zones, especially if accompanied by volume spikes or rejection candles. Then target the next confluence zone in the opposite direction for your take profit. Layer 3, institutional order flow analysis, is the most advanced technique. It combines all 4 profiles with delta volume analysis to read institutional sentiment. Start by comparing the delta volumes across all layers at key price levels. When shorter profiles show positive delta, while longer profiles, 1 and 2, show negative delta at the same level, you're seeing recent institutional buying against historical selling. This often indicates a sentiment shift. That is, institutions are changing their bias at this level. On the contrary, when recent profiles show a negative delta, while historical profiles show a positive delta, institutions may be distributing into what was previously an accumulation zone. Use the volume profile edges, the highest and lowest points of each profile, as additional confirmation, as these edges often act as hidden support and resistance levels that retail traders never see. The beauty of this multi-layer approach is that you're seeing institutional behavior across multiple time horizons simultaneously, giving you the complete picture of smart money flow. Before I show you the next strategy, remember this: learning indicators is one thing, but applying them within a structured process is what really matters. That's exactly why we've created a place where you can review these strategies, see live examples, and study them in real market conditions. Just click the first link in the description whenever you're ready to explore further. Now, different markets require specific calibrations for maximum accuracy. For forex pairs, set length to 150 and bins to 40 for major pairs. Forex institutional flow happens during specific session overlaps, so longer periods capture more meaningful accumulation zones. Pay special attention to profiles 2 and 3 POC confluence, as forex institutions often work on these intermediate timeframes. For crypto, drop length to 80 and increase bins to 60. Crypto moves faster than traditional markets, so shorter periods capture more relevant positioning. For gold, use length 120 with bins set to 45. Gold shows excellent institutional patterns during Asian session accumulation and London-New York distribution. Profile 1. Confluence zones are particularly strong in gold, as long-term positioning carries more weight. For stocks, set length to 100 with bins at 50 for SPY, QQQ, and major indices. Focus on pre-market and post-market institutional positioning revealed in profiles 3 and 4. Delta volume analysis is especially powerful in indices, as institutional program trading creates clear directional signatures. Thanks for watching, and I'll see you in the next one.